Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook. And we're going to spend 30 minutes here talking about, I guess, earnings. Earnings trades have been all right. But today it was really annoying, to be blunt. We did take two. We had a real solid strategy on take two, and we're going to be okay on the trade. But we should have been able to do better. And then it's kind of annoying to be right and then just not get the movement that you need. Usually that just happens in Tesla, but today it happened in take two. They missed on some things. They were a little bit frothy on their valuation, and the stock is down $2. It's down. It's almost like the event didn't even happen. Is really what's going on with take two. So. Here's where take two is at, and we sold. Our plan was to buy take two, long call, ride it into earnings, get to earnings, or I'm sorry, long put, and get to earnings. And if the downside move doesn't happen, then we're going to roll into a bear put spread or a put debit spread. And we did that. The market drifted higher. We had that opportunity. We sold the put debit spread, and now I would just get out of the position. Just flat out close it. If you did the two legs, if you hung with me on Options Guy TV for a minute, you should be out at about break even on the trade. And we'll see where that position is at. And then we're going to go and look at Home Depot. Home Depot is going to announce earnings. And once again, just like Walmart, it's going to be interesting as to what the comments are after the big event. And Walmart did say things are slowing down, but they always have a good presentation, and the market has jumped back now. And mainly because they made a real good pitch afterwards about the low cost leader. They mentioned that that some products that inflation is coming. Let's just cut to the chase. That's basically what they're saying. Everybody knows it. Tariffs are here. You can't just raise the cost of items coming in and not have that cost be translated in some way, shape, or form into the products that are being sold. And they did a really good explanation. They had the chief financial officer on CNBC, and he had a really good explanation as to it might not be in this one widget where that went up, but what they'll do is look at their whole pricing metrics across the entire spectrum. And honestly, I think it's because of that conversation and how well that person performed that the stock is up today. And I expect Home Depot to miss a little bit and then go back up also. So I'm going to get bearish on Home Depot. And I really wanted to do a skip strike butterfly, but there's just no vol. There's no volatility in Home Depot relative to, take two or any of these other high flying tech stocks. I mean, it's trading at a 4% implied volatility, and the company is set to announce earnings on Tuesday before the open. I'm going to emphasize that it's before the open. So Monday we could come back in and we could look at this trade if we wanted to, but I'm just going to look at, I'm just going to set it up today. I'm going to set it up today. I don't necessarily know why. I'm just because today is the day that I decided to look at Home Depot. Tuesday before the open. If you want to do this on Monday, we will have a show on Monday. You could look to do it then if you would like, but I kind of like getting bearish on Home Depot. I like that the vols are up a little bit, and we're just going to do an open wing butterfly on the downside in Home Depot. Is there anybody out there that has any questions on take two? What I would just do is just close it at this point in time. Right now, you should be in a long put spread, and I can give you the strikes if we need. The option contract that we ended up selling ahead of the earnings report was the 217 strike put, the 217 strike put. We brought in a couple of bucks, $2.10 for that trade. And then the one that we bought, let me run back and look at that from take two. We we bought the 230 strike. Let's see where that 230 strike is at. See, because like I said, it's annoying. They if you're gonna go down, go down. What's this $1 thing? That's what's up with that, right? We got the 516 expert. That's not 516. Yeah, 516. 516. Okay. Yeah. You got to just get out of the position. We paid $9.70 for that put, and we brought in $2, offset our risk, and now we're trading for $1 on that 230 strike. And obviously the out of the money option contract is 0, so ended up losing about $5 on the trade. That's not a good trade, and it needed to go down, and now it's still drifting higher. So get out while you can. Try to get as much premium as you can on this option contract that's right at the 230 mark. All right, now Home Depot. So in Home Depot, the earnings is here's the expiration, the May 7th expiration, and this is the expiration that we want to use. Now they announce on a Tuesday, so with the butterflies, it's always tough in that you need implied volatility to come in, you need time decay to happen in order to really start getting the maximum that you could on a butterfly. So it'd be better if they announced on a Wednesday or a Thursday, just to have a couple of days less of time value in the option contracts. But they're announcing on a Tuesday, and I've talked about that a lot. But I still like to trade, and here's the reason why. Implied volatility is at 40%. It's not quite double. A lot of times it will double ahead of an earnings event, but it's not quite double. But it's just not that high, right? So if implied volatility comes down and it starts trading closer to its historical vol, well, that's the time decay that we need, right? The fact that it's only going to trade at a 28% implied volatility, where if it happens in take 2, the vol would come down to a 50% implied volatility, right? It'd be at a 100 and come down to 50 or something equivalent. In this instance, we're at 40, come back down to about 28. But it does make the butterfly a little bit more expensive that we can't sell as much implied volatility. All right, that was a lot. Any questions on that? Everybody get that? All right, so here's the trade. We're going to do an open wing butterfly, and we'll send it to the trading floor. Not to the trading floor, to the trading ticket. And we're going to be bearish. Here's where the market is at, 379 right here. See if they can do, well, the only thing I think that you would probably hear on Home Depot is see if they could craft their message as well as Walmart did. If you say that. But Walmart actually had one of their worst quarters in quite some time as far as the actual numbers are concerned. And also they are concerned about a lot of the products that they're selling being a higher cost to them when they get to them. So those were two big concerns, and they crafted a message enough that the market is actually up in Walmart. So that's fairly impressive. So it's all about what Home Depot is going to say after the fact, and that's actually the case on a lot of these. Some companies have just stopped giving guidance. That's usually a bad thing if they announce that they're going to stop giving guidance, and we'll see here. So with Home Depot, we are at 379 at this point in time. We are a little bit inflated relative to the binopoly that they have with Lowe's. Lowe's is a little bit of the cheaper one out of the two. But in this instance, we're sitting here at 379. We're going to go out and buy just out of the money put option. We're going to buy the 377.50. We're going to sell 2 of the 367.50s and buy 1 of the 362.50s. I like this price, about 250 or 233. Yeah, so it's came down a little bit. If anything, the market must have moved up since I started the show. So I like the 236 mainly because we opened the wing. So we are going 10 points wide from 377.50 down to 367.50. That's 10 points. And then we're going 5 points on the next level. We're going down to 362.50. So to start with, we're here. We go down to here right at this is 367.50. I'm sorry, I apologize for the 50-cent things. And then if we go this direction, the maximum we can make is 267.50 if we fill at this price of $2.36. So the fact that our short put spread in our butterfly is 5 points wide, and our long put spread is 10 points wide, that difference is $5. You take $5, you subtract the net debit that's paid, and if the stock blows through the strikes to the downside, 267.50 is the maximum you can make. If it goes up, there's really not much we can do. We could try to adjust it, and we could roll into a short put spread, which would be bullish. It's Wednesday. We'll look at that. If the market goes up, I doubt, with the vol premiums as low as they are, I don't know if we'll be able to adjust this with 1 day remaining. All right, let's make this the official paper trade. But I'm also going to take this trade and let's move it out a week. Mainly because if we move it out a week and it goes against us, there's an adjustment that we could do to the position. This one will pay. Okay, so I'm being disjointed in my message. Okay. Home Depot, I'll tell you my whole process today. After the Walmart earnings, I wanted to get short on Home Depot. I really wanted to do a skip strike butterfly. And the reason why is that if it does go up, I don't think it would go up. I don't think it's going to blow the numbers away. I just don't see that happening in this marketplace with everything that's going on. So I tried to set up the Home Depot trade and look at the skip strike butterfly. But if I scroll up here and I look at this range, there's just no premium whatsoever. You could go 2.5 points wide, maybe. But if you go 5 points wide, it's just 190 to 296. This is basically $2 versus $3. You're looking at a $2 net debit to the account. So it's really tough to pull off the skip strike butterfly on earnings with implied volatilities at 40%. So I said, okay, if they're so low, then let's move the other way and let's just get bearish because we want to lean bearish, and we'll do an open wing butterfly. And the thing about it is, like Walmart, the move was muted. Take Two, the move was muted, where the market's just not moving as much as anticipated by the expected move. So this trade is interesting in that if it does drift down and it hangs right here, you could be paying $236, and the maximum upside is $1,000. So this gives you more upside on the trade. But I did really like the skip strike butterfly. Okay. So we can put that on. That's going to be the official paper trade. I sent it to the what if calculator. That's where my screenshot's going to be. But just in case, I want to see. Once again, this is all about learning here on Options Guide TV, right? I normally would do that one expiration that's going to be on Friday. Let's go to the 14th and see if they miss, if there's enough time premium to adjust. And we really won't know. This is trading at a 30 vol. I mean, we're almost at the historical vol on this, and they got earnings. So that's just interesting. What is the expected move? If we go at the Mace, and it's 39.80. So we're talking about 9 on the ask and 8. So we're talking about 17. 17, if we buy the at the money straddle divided by 379, well, they're still looking at a 4% move. That's nothing to sneeze at. That's a decent move. Apple usually trades at about a 4 or 5% move after earnings. So that's a decent move, but man, there's just no vol in it. All right, so I digress. Here we go. This is going to be the alternative one. We're going to look at this trade also. We'll do the same strikes, and I'll send this one to what if calculator. $377.50. We're going to buy that. And we're going to come down. We're going to sell 2 of these. Oops. Buy. Sell 2. And buy. All right. All right. So we're a little bit cheap. Well, we're about the same price, actually. Not too much more. 230. We still got the same upside. So let's send this one to what if calculator. Make sure that 530. And honestly, you might say, well, why is it the same price? And it has a lot to do with the fact that this is a 40 vol and this is a 30 vol. That's simple. You're trading 30% implied volatility on that one. If we go and look at this side of the equation, come on. You're looking at 38 vol. So yeah, definitely a different situation, right? And that's why, so the higher the implied volatility, the cheaper the butterflies. The higher the implied volatility, the cheaper the butterflies on the entry. So if you're right about your forecast on a butterfly, you want implied volatility to come down. Why? Well, because you're selling 2 option contracts and you need those to get to 0 or as close to 0 as possible to make the maximum on the trade. So you want implied volatilities high, ideally, when you're putting them on, and then you want implied volatilities to come down afterwards. That's why I like to do butterflies around earnings, especially when you have the Thursday earnings with just the 1 day to live on the Friday. All right, so I like this one. This will be number 2. Let's send this one to the what if. Oh, I already did, I think. Okay, so we got both of these in. And we'll look at this. So here's what my initial trade was. This is what I really wanted to do, but I can't do it 5 points wide. But I'm looking at it. Maybe we can do something halfway decent with a 2.5 point wide butterfly, which is boring, but let's look at it. So here's the skip strike. Delta is 20 right here. And yeah, I like the nice round number of 400. It's just, stocks have a tendency to stop right around big round numbers. So let's buy this one, sell that one. Oh, shoot, I did it again. We got to clear out. Here we go. Let's buy this, sell this one twice, skip that, and buy this. Getting 27 cents. You're only 2.5 points wide, so you could do a few of these, right? Because you're talking about 250 minus 27. Well, let's say 25. Let's make it 25. So you're 225 per butterfly that you did. If you did 3 of them, you're talking about $750, and you're bringing in 75 cents. I think I like this one. I think I'm going to do this trade, but I'll do it a lot because you still got the hedge. Vols will come in. I wish they were announcing on a Wednesday or a Thursday, but they're announcing on a Tuesday. Yeah, I don't mind this one. Let's send that one to the what if. We're going to have a lot to talk about on Monday. All right, so we got votes. Let's vote. Let's open this up to the marketplace. If you're out there and you're listening, we came up with 3 different butterflies on Home Depot. We're going to do the short-term butterfly. We'll call this one number 1, where we're doing this one would be here. The 5/23 expiration, which would be the next week, a week, 7 days from today. 5/23 butterfly with the same strikes, paying about 225, 230. I guess it was 230, 240 for it. Or do we go out another week to the 5/30 expiration, do the same strikes? Or do we do the skip strike? Which one? 1, 2, or 3? Do we got it? Is there anybody out there? Somebody comments. There's got to be at least one person that has an opinion on this. Which one do you like the best? I'm kind of leading. This is a tough one for me. I don't really like how tight the skip strike butterfly is, but that's really what I wanted to do today. Because I basically, what I'm expecting from Home Depot is probably a similar type of move that you might get in Walmart. You got the down afterwards. They came out with their comments. They made the market feel okay, and now the market's up a little bit today. And that's this one. All right. Thank you. Somebody. Shoo. Oh, Anthony, I love you. You like to call skip strike. Yeah, Anthony, I might join you on that trade. I might join you on that one. Yeah. I mean, it wouldn't be bad if Anthony, let's throw one more in here. Let's just throw one more. We got, it's 11:22. We got a little bit of time. I don't like doing the skip strike and going too far out because the long call spread doesn't reward you enough if you have too much time and it gets to that strike. But Home Depot trades at a low enough volatility that it may. So I want to look at all three. This is really going to be a pricing options guide TV, if you will. So let's go to the 14th and do the same thing. Now, the strikes will change a little bit because this is a 20 delta, and we're going to stay at the 20 delta, but we're going to go out to the 14. So it's going to move up a little bit. Okay, so 20 delta on the 14th, or 14 day, the 30th is right here, 400. Okay, so we just moved a little bit. Oh, there's no 2.5s. Ah, we can't get it done for a net credit with this. Buy, sell 2, skip this, and buy. Yeah, we can't get it. We can't do our experiment. Sadness. We need the 2.5s. This is done for a net debit of even, and I don't want that because whenever I'm doing the skip strike, it's an alternative to a short call spread. We're trying to make the premium on the trade. And that's really annoying. They don't have the 2.5 point strikes. And I doubt they'll have them in June either. Yeah, they don't. Such is life. All right, the call skip strike. All right, Anthony, I'm going to join you on the call skip strike. So we're going to look at all three of them. Let's study them. We'll look at them on Monday, and then we'll come back and take a peek on Wednesday. Is there anything out there we have earnings-wise that we want to look at next week? So we've been kind of hot on our earnings trades. Obviously, today this one didn't work out on take 2 because for some reason the stock decided to go down 1 instead of 10. But oh well. We got TJ Maxx, we got BJ's at the end of the week. So everything's basically retail that we have going on. Zoom is announcing on Wednesday after the close. So we could set something up for Zoom on Wednesday. I like that. That will be our trade Wednesday. Are there any ones that anybody out there is interested in that we can talk about? We got TD Bank on the open on Thursday. Well, here, let's zoom out, and then we'll leave the show at that. We'll leave it with that thought. So I'm grabbing this from x.com. This is earnings whispers. Here we go. And these are the earnings reports. So here's what our target will be. All right, let's go back. Here's our target. So we got, see what I did there? Here's our target. On Wednesday, we got target. On Tuesday before the open, we got Home Depot. So these are two interesting ones. Target probably trade at about the same vol as Home Depot. Zoom is here after the close. Snowflake, that's after the close too. I'd like to look at Zoom. BJ's Advanced Auto Parts. Advanced Auto Parts is always, if you these companies do well if you think the economy is going to become weak, but tariffs are obviously going to be an issue a little bit because of auto parts. This is an interesting one to watch. Advanced Auto Parts is interesting to watch. But in times of recession, a little bit kind of like liquor stores, usually auto parts stores and liquor stores do well, but the concerns of recession have waned a little bit. A couple of people came back down, thankfully, down towards the 35%. I guess there's the perception of the deals are happening, and that's making the market feel good. I'm still surprised the VIX. I am long VIX calls going out 2 different expirations because realize that that's a trade that you're going to lose on. You're going to lose on before. In other words, the VIX trades, especially if you're buying like long calls, are trades where you're down until you're not, right? So I don't ever apply on VIX positions necessarily the same rules that I would on a Home Depot butterfly or a Home Depot long call spread, because I'm just putting it on and I'm looking at it as an all or nothing trade, and I'm putting in the amount of money accordingly on a VIX, because the VIX, once again, it could be at 0, your option contract completely worthless, and then the next day it could be trading for 10, and that's the way the VIX works. But we're in at a good price. The VVIX was at 88 when we looked at that trade, and the VIX was at 18. Okay, and then Autodesk Workday would be an interesting software company that's going to be a little bit insulated from the tariff wars, and that's after the close on Thursday. Yeah, so we got some interesting ones. Is there anybody, if you have any that you are interested in, please put them in the comment box, and we will try to address them on the show. I will take a peek at that before the show on Monday. So put them in the comment box for this show, and we'll come back out and we'll trying to make this a little bit more interactive. We want to get you involved. We want to grow the show. We want to make it fun. Our trades have been solid recently around the earnings, but they are speculative, and you shouldn't be going overboard on these type of trades. But we're learning a lot, and I like this Home Depot situation. All right, so the trade that I think I'm going to put on is I think I'm going to join Anthony. That's in the comment box right now. I think I'm going to look at doing more than one of the skip strike butterflies on the short term, bringing in a small net credit, but doing it 5 to 10 times. I'm going to go a little bit more on the upside, and only because we're only 2.5 points wide on the risk. Normally, we would be 5 points wide on the risk, or maybe even 1,000 points wide on the risk. But now we're only 2.5, so we can do a few more of them. And unfortunately, they didn't have 2.5 point strikes going out a week later. Thanks for coming. That's it. I'm done tapping out. Enjoy the weekend. Follow me on x.com. Handle is @BrianOverby. Please share with your friends and family, and give us some comments. Give us some feedback. Let's see what we can do to try to make the show better, and address any of the companies that you want to look at next week. A lot of retail space that's happening, and see where we're at. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.